I checked my bank account and I actually saw this. Singapore Savings Bond application partially successful. I actually applied for $20,000 worth. And as you can see in this screenshot, savings bond refund of $11,000. Why is there a refund? Now, quite simple. I actually applied $20,000. And if you see the official results, you realize that the total amount allocated was $700,000, but the total amount applied was $2.4 billion. That is why everybody who applied got only $9,000 allocated, and if you are lucky, $9,500. So I'm not the lucky winner. I only got $9,000 allocated. But again, the amount that was applied is staggeringly high. Now everybody's talking about AMO residences being 98% sold out on its first launch weekend, but Singapore Savings Bond, I think it's even more popular than it. So today, if you're curious to find out why I had this title, Singapore Savings Bond dropped, I'll be sharing with you more details on it, and I'll be sharing with you latest data for this new upcoming September issue. So if you're keen, continue watching on. Hi guys, welcome back. Let's jump straight to it, and I have 2 points for you. The first is a drop in allocation rates. In the previous July issue, which was for subscription in June 2020, the allocation that I've gotten was $18,500. But for this one that just closed, I only got $9,000. So as you can see, the amount that is being allocated looks to be getting smaller and smaller. So if we look in terms of historical data, you see that the maximum offered actually by government has steadily increased, correct? Previously it was only 150 million. Then in May 2022, it jumped to 250 million. And then it increased on a month-to-month basis. And as of this latest issue, September 2022, it is 900 million maximum offered. So it's not like there's a lack of supply, but rather the demand has just gone through the roof. If you see the total amount applied, you realize that it almost 10x over the last few months. Now maybe for myself as well as my fellow peers in the financial influencing industry, we've all done the good work for government to share this great product. And that's why there's so many bids coming on board. But if you see the amount allocated, you realize that it's been dwindling, correct? Because supply increased by 4-fold, but demand increased by 10-fold. That is why the quantity ceiling has dropped ever since May 2022. Previously, you apply for 200,000, you get 200,000. But then it dropped to 15,000, then 18,000. And then the latest one, only 9,000. So my suspicion is this latest one will also be around $9,000 only. That means one thing, don't go bidding for 200,000 worth. It's very unlikely that you get the max. Again, my suggestion is go for 20,000 worth and expect only partial allocation. Then let's move on to the second part on what has dropped in Singapore savings bonds. Now, if you look at the thing that catches the eye the most, that is the 1-year interest rate, correct? The latest issue for September 2022, which can be applied now in August, you realize the interest rate for 1 year is 2.63%. If you compare that to the previous issue, that was only 2%. Wow, that means a jump of 0.63%, correct? And this easily beats any fixed deposit that you can get when you walk into a bank right now. A key reason for this increment for 1 year rate is because Fed in US has actually raised the overnight Fed funds rate by 75 basis points, which means 0.75%. So the question is, what exactly has dropped? I don't know if you've seen it or not, but let me draw your attention to things. If you scrutinize for the second year onwards, you would realize that the interest rates on a yearly basis is lower actually than the previous issue. Second year now, you're only getting 2.71%, but in the previous issue, it's 2.86%. You move on along the line and you realize that the average return on the 4-year mark, right now you get is 2.69%, but previously it's 2.74%. Now coming to here, help me smash the like button, especially if this information was something that you didn't quite realize, and together we can reach a bigger audience to educate everybody on what to look out for, because this is a great product. We just need to know how it fits into our own individual needs. So let's move on along the curve. You realize that the 10-year average return mark now is only 2.8%. Still better than CPF OA. So maybe for this year, a lot of people are not really trying to do CPF top-ups that aggressively. But if you compare it against the previous issue, you realize that that average return was 3%. And the 10-year actually yielded a 3.29% on that last coupon. So if you're looking for a chart, this actually gives a good description. you realize that last issue seems to be an all-time high at 3% average return for a 10-year mark. That is actually in the blue line over there. The dotted red line is the 1-year yield mark, and that is going to correlate a lot to what is going on in US Fed when they change rates. So the question is, why exactly has the 10-year mark dipped, but the 1-year mark is still climbing aggressively? And how will future issues for Singapore savings bonds look like? Now, nobody knows for sure, but I can suggest some clues that can be found in US Treasury rates. You see that Fed rates affect the nearest term overnight lending rates. And let's not waste too much time speculating on it too much. But if we see what the bond markets are telling us, you realize that the 2-year Treasury yield is now dropping already. It peaked out in June at 3.4+%, and it has now declined to 2.856% already. Then what about for the 10-year Treasury mark? You realize that it also peaked out in June at 3.4+%, and right now it's lost almost a percent already, now closing at 2.536% only. Now this relates to a term in finance called the yield inversion. Yield inversion is when the long-term rates are supposed to be higher than the short-term rates, because in the long term there's more uncertainty, correct? That is logical. But when the long-term rates are actually lower than the short-term rates, that suggests stress in the near term, where long-term wise things look to be normalized. This yield inversion was just a slight amount in June and it was pretty fickle. But as of right now, the inversion is very obvious already. And in my opinion, is yet another leading indicator that a recession is looming. Let's draw back all this that we've learned into the Singapore savings bonds. What we can see is that the long-term rates are declining faster than the short-term rates, which also explains why the Singapore savings bonds for September issue is not climbing that much in the long-term rates already. And when we use the Singapore savings bonds, I believe in focusing more on the 10-year rates. Why so? Singapore savings bonds is not meant to build your wealth. It barely or ever covers inflation at all. It is a good place to park your emergency cash only. You know, emergency cash, this concept, is when you put some money aside just in case you are retrenched or just in case you have certain level of critical illness that you need funds, that you need cash. Which means also this amount that you park aside, could be 30,000 or 50,000, does not change too much across years because your emergency needs are just that amount. So what we want is not to profit from the 1-year rate too much, but rather a place that you can park and get decent returns for the long term, which means quite possibly the 10-year mark is where you stash this emergency. If nothing happens in 10 years, you just keep collecting interest on it, and you might use it when that situation arises. What I hear a bit on the ground right now are stories of people who are concerned about the market downturn. Everybody is thinking that market will crash, or they've gotten burned and are becoming very risk averse. But since you're in this community, let me reiterate again. To build wealth, you have to be in the equity markets. The 1-year interest from Singapore savings bond is not meant to get you to financial freedom. So don't focus too much on it. A market downturn is actually a time whereby you plan how to deploy and get into the equity markets so that you succeed financially in the long term. With that, I'll give a quick shout out to today's sponsor, Webull. Webull is a platform that allows you to trade US stocks and Hong Kong stocks for $0 in commissions. And right now, if you are a new account sign up, you can actually stand to get $100 of Google shares. It's a pretty good offer and I'm a user of the platform. So if you're keen, look for this QR code or check out the links below to sign up today. And since you stayed with me to the end, I've actually some bonus points for you. The first is that I'll be launching a sequel to this video touching on a concept of a bond ladder. We can actually use the Singapore savings bonds to build a bond ladder, especially if you are a retiree or really going towards this retirement phase already. Then building wealth is not the immediate focus. So if that video is going to be of help to you, smash the subscribe, stay tuned for it. Then the second part that I found interesting is also at this stage, you realize that long-term interest rates are declining, correct? Which means the prices of bonds which are very long dated may have reached a near-term bottom. I don't know about it. But that also means that perpetual bonds, which have no maturity date, could also be attractive. One example is actually Wing Tai Holdings bond. This perpetual bond pays 4.35% in terms of coupons. This is a wholesale bond, but because of the price decline, you realize that now the ask yield to worst is 6.025% already. Now, Wing Tai is a developer in Singapore that I'm pretty familiar myself. I don't know if you know them a bit, because if you want to buy bonds, you have to be comfortable of who is issuing it. But to me, that is an interesting point of view. perpetual bonds could show value, and I've helped retirees explore what they can do with their savings in my advisory practice. Hopefully this tutorial on Singapore savings bonds, this update is useful, and I'll see you in the next video. Take care as always. Goodbye.